Hello, everyone, and welcome to today's webinar, Deep Dive into Income. Now, as we go through the slides, we're going to cover a lot of information today. So as questions occur to you, go ahead and use the questions function, and I will ask the speakers for you on your behalf. We're also going to have an additional Q&A session at the end, but we want this to be as interactive and meaningful for you as possible. So please go ahead and feel free to ask your questions as they occur to you. With that, I'm going to turn it over to today's speakers. Take it away, John.
Well, to those of you on the East Coast, good afternoon. To those of you on the Mid-America and West Coast, good morning. My name is John Kolitz. I'm the Regional Sales Manager for the Northeast United States, and I am joined by...
Hi, I'm Loretta Rohani, and I'm a Regional Sales Manager for the Southeast.
And I am Tim Turley. I'm the Director of Underwriting and Operations for the Eastern United States.
And I might add that Tim is recently a new grandpa, so congratulations, Tim, on your grandson.
It's awesome.
It is. It's a great club. So I know we don't look old enough, but we are. So anyway, today's agenda, we're going to talk a little bit about who is LendSure, a little bit what we do, the different types of income, combining income types, the opportunities. We're going to talk about our Spark pricing engine, marketing resources, and we're going to open it up for questions and the answers. LendSure was founded in 2015. We're headquartered in San Diego, California. We've got centers in Rhode Island, Georgia, Utah, and Missouri. Those continue to grow. We've been securitizing loans since 2017, and when I tell you, we probably do have the #1 management team in the industry. We really do. We've got a history where our co-founders have been sought by basically almost every major lender in the country to buy loans from us. So we're in 47 states now, and that continues to grow. We are strictly a non-QM lender. We don't do Fannie, Freddie, FHA, VA. People sometimes say to me, well, what is non-QM? Well, non-QM, I guess the best way that I could describe non-QM is we determine the borrower's ability to repay differently than does Fannie, Freddie, FHA, VA. That's probably the biggest difference. Would you agree with that, Tim?
Yeah, absolutely. We tend to make loans that make sense, not necessarily fit in the box, but we want loans that are going to make sense, and we believe the borrowers can pay us.
Beautiful. We've got some great products, including our interest only. We have one product that's a 1040. It's a fixed rate for 40 years, where the first 10 years is interest only, which is a great product. People are really, really liking. That's very popular. We have expanded income documentation programs, and then we have different kinds of properties we can do. We do single family 1 to 4. We can now do 5 to 8 unit properties. We do non-warrantable condos, which is also very popular, and we're doing condo-tel loans. We have different types of income that we can do. Of course, we can always do full doc income, your pay stubs, your W-2s, your tax returns, things of that nature. But we also have a couple of different ways that we can verify people's income, such as 1099, the bank statement loans, 12 and 24 month, asset depletion and asset qualifier. And we're going to dig a little bit deeper into some of these products and some of these ways that we can document your borrower's ability to repay. Probably our #1 loan as far as business that we do is our bank statement loans. A lot of times my brokers will come to me and they'll say, well, how do I know what the number is that you're going to be willing to use so I can determine how much can my borrower qualify for? How much of a house can my borrower afford? Well, we will do an upfront evaluation for you if you send us the 12 or 24 month bank statements. Our credit analysts will review those along with the credit, the self-employment questionnaire that we're going to ask you to have completed by your borrower. And then we'll go ahead and come back to you and we'll say, this is the number that we're willing to use for ability to repay. Unlike most of our competition, we do not require a CPA letter or P&Ls. The borrowers do not have to own 100% of the business. We've done quite a number of loans for borrowers that own 30, 50, 70% of the business. So again, they don't have to own 100% of that business. We can use multiple business accounts. We've got borrowers that have pizzerias that have 7 locations where you have 7 different bank accounts. That's not a problem. We can go ahead and use that. One of the big things in our industry and in the bank statement business is that variable expense ratios. We're always going to apply an expense ratio based to the gross revenues for those bank statements to come up with the final number that we're willing to use for the ability to repay. That expense ratio could go anywhere from 10 up to actually 90 to 95%, depending on the type of business. On our bank statement loans, we can go up to 90 LTV with a 740 FICO. We can actually go down to a 640 FICO as low as 80, and we can do 12 and 24-month bank statements. Now, one of the big things, and go ahead, Loretta.
Can you just share a little bit about the 1099 and why is that different than the bank statement? Since most of our competitors put 1099 borrowers on bank statement.
Well, so on the 1099, in fact, Tim, if you'd like to add to this as well, but the 1099 is basically what quite often you might have a manufacturer's rep, or you might have somebody that is basically compensated 100% commission, but instead of being paid on a W-2, they're being paid on a 1099. Anytime there's a 1099 transaction, we're gonna ask you to still send in the 4506 so we can verify that 1099 income, and then we're also going to be looking for the self-employment questionnaire to find out, do they have expenses that they are going to incur as a 1099 employee? I've actually had transactions where they do have expenses, minimal, and some that they have none.
Yeah, we recently had one for you, John. That actually, the guy had no expenses. The company paid for everything. I remember the questionnaire, every question on there, the borrower said that his company paid his expenses in addition to his 1099 income. And I think we ended up at a 10% expense factor on that.
Yeah, and it's important to understand when we give you the self-employment questionnaire to have your borrower and really pay attention to the questions that we're going to ask. I'll give you a perfect example. We had one not too long ago, Tim, I know you were involved in this, where the borrower said that their cost of goods sold was $40,000 a month. Well, 18, 19, 20, 21, 22, 23, 24 months ago, their revenues weren't even $40,000 a month. So if you're going to use a cost of goods and you're going to have varying levels of income over a period of time, and if it's a variable expense, if it's going to be a percentage of gross revenues, put that in as a percent versus as a dollar amount, because otherwise my credit analyst is going to assume it's $40,000 every month for the 24 months, which might throw off the numbers and might make it so that we don't qualify. Tim, did you have anything you wanted to add on that, or Loretta?
I would say, the variable expense factor is something that most of our competitors don't do. They have a set ratio, whether it be 50, sometimes they'll go down as low as 35, but they miss loans, quite frankly, for good borrowers, because we had a consultant last month who worked out of her home and she virtually had no expenses. It was denied by our competitor because they just simply applied a 50% expense factor. We were able to feel good about a 10% expense factor, and we made the loan. So I just see that it's a real win for our customers when they've got a borrower who truly doesn't have a lot of expenses. And there are a lot of businesses out there, especially as much stuff's done on the internet now. The one thing I wanted to add about the bank statements that I didn't see in the bullets, but we can also take a borrower who's got a business bank account and they pay all their expenses through their business and average their personal to get the income from that. And I think that's kind of unique in some ways, because a lot of times they're depositing money into their personal account and paying all their expenses out of their business. And it gives us a good picture of what their income is. And we can apply a 0% expense factor to the personal accounts if we can validate that the business is paying all the bills out of the other account.
What would you need them to produce to you to use that 0 expense factor from the personal?
Typically, we just want to see the last 3 months of the business. Obviously, we're going to want to see 12 or 24 months of the personal, but we just need to validate that the expenses from the business are being paid from a business account.
You're saying we could
We've also run into a lot of deals where the borrowers have had COVID issues 12, 18 months ago. How have you dealt with that?
Yeah, I think we've probably taken a proactive approach differently than some of our competitors there as well. One of the things that we looked at early on were businesses were shut down. In some cases, we've had people that work, businesses located in a mall, for instance, and the mall was actually closed because of COVID. The business wanted to continue working, but they literally could not. And so one of the questions on our questionnaire is, have you been affected by COVID? And if so, how? And we're going to look at that. And if their business was closed for 3, 4, 6 months, whatever it was, we may take 24 months worth of bank statements and disregard those 6 months and say, well, you weren't open. So we've got the 24 months. You can clearly see there was no revenue. And then we're just going to, rather than take a 24-month average, we might take an 18-month average.
Guys, I got a couple of questions. Eduardo wants to know, can the 90% LTV be on a 4-unit owner occupied?
No.
What would be that the max LTV on that, if you happen to know off the top of your head?
We might, it depends on whether it's 12 or 24 months. On 24 month, we could probably get to 80.
Okay, great. And then Teresa, yes, I am going to be sending a copy of the slides to you, and all of the attendees take a look for an email from me about an hour afterwards, and I will and that'll have a link to the slide deck. So you guys don't have to worry about taking notes, just worry about just talking to the speakers.
Yeah, and adding to that, Rose, we're not going to read every slide. Some of these slides are going to be there for your use later as a reference. So don't worry about us sitting there and reading every bullet on every slide.
Mm-hmm. Okay.
Okay, so let me see here. Why is this? There we go.
I think we meant, there you go.
Going to talk about.
That's what we've been talking about.
Yep.
Mm-hmm.
So I'm going to skip past this one because it's going to be something for you to use. Loretta, you're going to go ahead and talk about investment property income loans.
Hi, everyone. So I'm going to just talk to you a little bit about investment properties and how we look at them and how we look at the income derived from those properties. So you'll see on the slide, we're going to represent that you have 3 different ways, basically 3 simple ways of looking at investment income. And what I always try to say is that look at them in categories. So full doc, highest LTV, lowest rate, bank statements, kind of middle of the road for both. And then your DSCR is going to be a little bit lower on the LTV, a little bit higher on the rate. That's kind of the way of thinking of the 3 different ways that we calculate it. We're going to dive into how we do full doc. It's full doc, as John was saying. It's W-2s, tax returns. If it's self-employed tax, using the tax returns, W-2s, or the 1099, because we do treat 1099 as full doc. And then the bank statement would obviously be bank statements. And then DSCR is the only one that's a little bit different. It's where it qualifies off the property itself. So the only debt ratio is the debt service that's generated by the property, which would be the gross rents divided by your PITI payment or your interest-only payment if you're opting to do interest-only. I'm not going to cover all of the guidelines. We did put the guidelines on in the slide for you so that you could see the difference between the expanded investor and the DSCR investor. So this kind of just gives you the touching points on the guidelines for that. If you don't mind, John, you can go ahead.
Okay.
So full doc income, when you're doing a full doc borrower and you're purchasing an investment property, one of the unique things about LendSure and the reason why a lot of our borrowers are able to qualify us when they couldn't qualify with Fannie is because of the way we look at the income that will be produced from the subject property. So when you're purchasing an investment property and that property has a 1007 attached to it, which is your income survey, it will tell you how much that property is expected to earn monthly in rental income. We will take that and use 75% of that to wash the payment, and we will include the negative rents or positive cash flow into the income. Can you go back up one slide? Yep. Just one more. And how you can see that
a little touchy today, John.
It is not cooperating very well today.
I think you got one. There you go.
There we go.
We're going to put this on display for you so that you can see the difference between, us and, conforming agency or Fannie, for example. When they look at rental income being produced, when you're purchasing an investment property, they are going to take the rents that are arrived from that property, and if there is a negative cash flow, they are going to charge that debt to the liability. So you can see here on this slide that Fannie Mae is calculating a total income from both of the borrowers, including the primary second job, at $13,257. And when you look at LendSure's calculation, you're probably getting a little skeptical, like, LendSure is saying that they're aggressive on their income, but it looks like they're coming up with a lot less income to $9,712. But you can see we have reduced the income by the amount of the negative rents from the properties that they already own and the property that they're looking at purchasing with us. So you can see the 2 different categories, the ones they already own from their Schedule E method, and then the one that they are purchasing in the process of purchasing. Over.
So we're dealing with it on the income side of the equation.
You see There's the payments. There you can see where Fannie did it, and they put it into the debt load, which generated a significantly higher DTI at 48%. But because LendSure removed it from the income, now you're only left with their primary housing obligations and their other reoccurring debt. So that put our debt ratio significantly lower at 30%. So basically, what you do is when you're purchasing an investment property, is you calculate their income normally. And then you look at the subject property and you say, what is the 1007 say I'm going to have for income? I'm going to use 75% of that. And if it's a cash flow positive, you add it to the income. If it's cash flow negative, you minus it from the income, but then you do not include the payment at all for the subject into the debt load. Garner you the best possible results.
Of Fannie Mae fallout because of this very reason.
This is why we pick up probably, I would say, a lot being in the 80% range from Fannie Freddie. That's why we pick up the fallout. So it really helps save your deals.
By the way, with those calculations, your LendSure account executive will help you with these. You don't have to remember and memorize how to do this. That's, they're experts in this and they can walk you through. Just talk to them about your scenarios and they'll do all the heavy lifting.
Absolutely.
So just to touch on it, just keep in mind on full doc and on bank statement, we would do it the same way. So if you were doing a bank statement loan, you would calculate the income from your bank statements, and on your new proposed property, you would do the same thing, deduct it. So full doc and on your bank statement loans, you would arrive at it the same way. So there's no difference between the two. It's just the documentation that you're using to support what your income is. You can go ahead.
Yeah, and I think it's important to note that on any income producing property that's business purpose, that we could use the interest only payment to qualify the borrower as well.
Yes.
John, Jerry wants to. Oh, I'm sorry,
ahead.
Loretta. Jerry wants to know what's the maximum cash out on and maximum LTV on an investment property, I guess across all programs.
So it's going to depend, Jerry. It's going to depend on whether or not you're doing the expanded investment or if you're doing the DSCR investment. So the LTVs are different. So if you're doing full doc, you can get up to 80%. Doing the DSCR, you can get up to 75% LTVs. And if you're looking at cash out, the cash out LTVs are reduced. It's going to be a number of factors. It could be if it's multifamilies, there's other variables. So the cash out LTVs are slightly reduced. And I believe, Tim, if you can correct me if I'm wrong, we still can get up to 500,000 cash out on investment.
Thank you. And that was Gary. My apologies, Gary.
I'm sorry.
No, that was me. I made that mistake.
On a DSCR, that's the number. But I will tell you, and we really haven't talked about this. I think we're going to get into it. Is we are not an inside the box lender. We make exceptions every day. Probably half the loans, almost everyone I look at has an exception on it. And this is an exception that comes up often. We've given $1 million cash out if the loan makes sense. It was a low LTV and we did it. So, we can quote you the guidelines and read what the maximum cash out is for each one of our programs, and are happy to send you all that information. But that doesn't mean that if you're outside that box and you've got a loan that makes sense, that you shouldn't send it to us. Because I think you two especially know, being the sales managers and working on this stuff every day, we lend outside of our own box a lot.
The funny thing is that you approved not long ago a DSCR that in Washington that was $1.5 million loan, and it was all cash because they had paid cash for the property, like $3.4 million.
Yeah.
So you absolutely, we definitely make exceptions to our.
Loretta, Mark wants to know if for the DSCR program, if the borrower has multiple rentals, how much information and documentation do you require on the other properties?
That's actually on this.
A great segue. This is the perfect slide for you, Mark. So all you need to do is you need to make sure that your REO schedule on your IRLA is complete. So making sure that all of your properties are listed with whatever their mortgage, or if they're free and clear, their insurance, taxes, separate maintenance. We don't require anything in relation to the other properties. We don't require mortgage histories. We don't require anything outside of the subject property. We just ask you to ensure that the IRLA is correct And then we are going to just say that if they do have mortgages, some of those multiple mortgages reported to their credit, they are going to be the entire mortgage history is going to be looked at it as it's reported to the credit. So, but if the mortgage doesn't report, not going to ask for anything regarding that.
Vincent wants to know
Completely.
if a client is purchasing the rental property, but it doesn't have a tenant yet. How can you use the market rents to qualify?
We use it right off the 1007 if it's a single family, and we use it off, but if it is a multifamily, they're going to give you the average rents on the multifamily form.
Okay.
It's expected or proposed rents.
Okay. Kathy wants to know, Katty wants to know, for a DSCR, what's the minimum loan amount for a cash out refi?
So amounts
The
are
minimum's 150,000. I can tell you that. And what was the second part of the question? Maximum.
I'm sorry, I just deleted the question. I think it was a maximum a minimum loan amount and LTV for DSCR.
The maximum LTV is 75. The minimum loan amount is 150. We have made exceptions to the 150 and gone a little bit lower, not a lot. And I think they also asked about cash out, which I think we just commented on, and we will do. Our guidelines say 500,000. I would say we make exceptions to that every week if they make sense and the LTV is lower.
Okay. And Elias has some questions about, wants to know about foreign nationals in DSCR, but we're going to get into foreign national income a little bit later. So I'm going to put a hold on that question.
Okay.
Yeah, so just a couple of things to remember on the DSCR is, again, it's going to be your rents as compared to your PITI payment or your IO payment if it's a business purpose loan. So just the way to think about that is if your rents are $2,000, you don't want your PITI payment to be over that. And if it is, then we will look at that on a case-by-case basis if it's under. Maybe Tim, you can elaborate a little bit on if it's slightly under what we would consider doing.
Yeah, we will consider them down to usually about 0.90. And it needs to be a lower LTV, 65 or less, but we'll still consider those on a case-by-case basis.
Wanda wants to know if
investors, right, Tim? That'd be a consideration that you would look at, right? Somebody that's got a little seasoning on managing property.
Yeah, and somebody that's on. I'm not going to do that on a first-time, investor type person. Why are you buying an investment property that's not cash flowing for a first-time investor? It doesn't make a lot of sense. But if you've got somebody that's got a strong history of investing and they're at 0.9 and a lower LTV, I think we would definitely do that one.
Okay. Wendell wants to know, he's investor has 3-unit property. Primary home is rental. Can you do a DSCR on that?
No. If it's his primary home, he
he's renting. He rents out of. He's renting his primary residence.
He's a renter, but he owns an investment property, so he's renting somewhere else. And yes, we can. The biggest thing is in that scenario is occupancy. So we're going to want to have strong verification that he is renting somewhere else. Typically, it's if he's renting very close to the 3-unit, it typically gets to be a little bit tricky to prove that they're not about to move out. Now, if he already owns it, all 3 units are rented, and he's got leases and can prove that he's got the money coming in, I don't have a problem doing that. Or if he's living and working in another state and owns a property, like he lives in, I did one the other day. The guy rents in New York, and he bought an investment property in Florida. And he already owned a couple of other investment properties. So it's a case by case, but if it makes sense, we will do that.
Okay.
Sorry,
just to cover really quick some of the DSCRs. So just again, this is an example of how to calculate the DSCR. And then I just wanted to point out that on our 5 to 8 unit, it's just slightly higher on the DSCR because those are commercial and they need to be for seasoned investors.
Very sensitive today.
Yes.
This is just an example. I just want to make sure that everybody's on refinances. Oftentimes the 1007 that comes back with the appraisal might be slightly under what the actual rental agreement is on the property. And here's an example of that. You can see in this example that the average rental income is $3,450, but if you looked at the lease was $3,900. So in this particular, when it's a refinance and you have a tenant in the property, all we would ask for is a copy of the lease and 2 months proof of receipt so that we could use the fair amount to DSCR you. So just keep that in mind. Comparison, just to show you that LendSure, if you are doing loans with our competitors and you're getting yield spread, almost nearly all of our competitors put your yield spread into the rate. So I'm going to show you a side-by-side comparison of a loan with LendSure and how we pay our lender paid compensation versus how our competitor does. In this case, we have a property that we're doing a loan amount of $500,000. So you can see that LendSure's loan amount is $500 and our competitor's loan amount is $500. And the rate from LendSure is 6.99 and the rate from our competitor is 6.99. The thing that LendSure does is we will stack compensation. In this point, we're recommending that you, if you were doing lender paid compensation, that you would do that at 1.5 for the lender paid comp. So if that would equate to about 1.125 with your investor. That's on our competitors in yield spread, that's what it is right now. They're paying about 3 to 1. And they would add that 3 to 1, which for 1.5 would in turn turn out to be 1.125 added to your rate. LendSure is not going to add it to the rate. We're just going to take your compensation of 1.5 and we're going to calculate it and add it into the loan amount. 2%. It doesn't have to be you don't even have to choose lender paid comp. You can, but you can also do that on borrower paid comp that will stack in the compensation over and above the loan amount. And all of our LTV buckets allow you to do that up to 2%. So for example, if you're doing a 70% loan, you could go up to 72. You get still priced in the 70% bucket. We're not pricing you in the 75 bucket, even though you went to 72. So we'll allow you to stack up to 2 points. So in the LendSure example, the loan amount goes up to 507,500, but our rate, you will see, remains the same for the borrower at 6.99%. Versus our competitor for that exact same compensation, for you to receive your $7,500 but pay it through the rate, your rate is 8.125. And what does that mean for the borrower? That means that you're going to have a $3,300 payment versus a $3,700 payment, or the savings of $336 a month. Now, in an environment where rates are rising, property values are rising, and DSCRs are getting a little harder to qualify, one of these options do you think your customer is going to want to choose? Personally, I think like LendSure option. That's just me.
Loretta, David wants to know, can loan and title close in the name of an LLC for DSCR?
You absolutely can. So, and we're gonna, that we can close in an LLC, and you can have, if you have multiple members of the LLC, as long as all of the members of the LLC are willing to sign the personal guarantee, you can have one of the members, as long as they're the authorized signer, be the qualifying borrower on your loan, so their income and assets can be used. So it doesn't even require that you have all, like if you have 4 members of an LLC, all 4 of them don't have to go on the loan.
Okay.
The person we have is the authorized party on our loan, the other members sign a personal guarantee, and we're off to the races.
Mark wants to know.
The only caveat on the LLC is that the LLC needs to be incorporated in the state where the property is located. Just keep that.
Speaking of which, so Mark wants to know, if a buyer living in San Diego and they want to buy a rental, how far away does the rental need to be?
It could be next door. In theory.
It makes sense, right? This needs to make sense.
We're not sitting there with a radius of 50 miles like some people do and say you got to be over 50 miles away to buy a second home or a rental property or anything like that. It doesn't have to be in a vacation area or something odd. You know, we have people all the time that buy houses close by because they want to keep an eye on their rental property.
I literally, Tim, if you remember, not even 2 weeks ago, you approved the one that was literally next door.
Literally, he bought the house next door.
Literally next door. The house next to his is his now rental property.
Guys, I'm getting several questions on exceptions for DSCR program. Will you make an exception for this? Will you make an exception for that? I've got a couple of different people asking about that. Do you want to just talk a little bit about exceptions?
Yeah, we look at our loans from, do we think the borrower is going to pay us? We don't necessarily look at them from a guideline standpoint. You mentioned DSCR, it's a little bit different there because we're going to look at the cash flow of the property pretty strongly, and we're going to look at our loan to value. So if you're the higher the risk, meaning say you wanted an exception to cash out, or say you wanted a credit score exception to go a little bit lower or something like that, if we're offsetting that by having a lower LTV, then we definitely consider it that way. We look to offset our risk with, as we say, the other legs of the stool. We look at 4 things when we look at loans, and it's income, equity, credit, and assets. Obviously, when you're doing a DSCR loan, you've removed a couple of those stools already. But if you've got a borrower with strong assets, right, and we're not looking at their income, so the property cash flows well, and we're at a lower LTV, then that would offset maybe some of the credit risk. And that's just one example, and they're all interchangeable. So, go ahead.
If you don't mind, Tim, I would add in there too, is that because you mentioned the credit, income, asset, property, and how we remove a couple of those, even on our DSCRs, we don't have a heavy asset requirement. So if you're doing a refi cash out, we can oftentimes, in most cases, use the proceeds from the transaction for any reserve requirements. And even on our purchases, if our LTVs are lower, we do not have a reserve requirement. So again, like Tim said, he's going to be looking for the elements of the, how is the property cash flowing? What is the experience of the person that is asking for the exception? Like what is this borrower's history with a investment property? But I often say, if you have assets, we don't require that you prove them. That's also a great compensating factor that we go to senior management with and say, listen, here's my compensating factor. I've got XYZ dollars in the bank. So
right.
Okay, great.
Yeah, and we've done a lot of loan amount exceptions. We've done FICO exceptions. We've done loan to value exceptions. It really, to Tim's point, it really comes down to the compensating factors. The one thing I would like to point out, though, is that when we do make an exception, it really changes the value of that loan on the secondary market. So more times than not, we're going to have to price for that exception. We might have to increase the rate a little bit or increase the points a little bit. So understand that, because the loan, when it's outside of the box, is not the same loan as it is when it's inside the box.
Yeah.
Very true, John.
Fair point, sir. Fair point.
All right, so I think we're ready to transition into the foreign national.
Yeah, I just was going to say this is just kind of a guideline overview, so we're not going to cover it. We'll just skip over that so that we wanted a presentation so you wouldn't have to go look for some of these details. So yeah, I believe, did you say Elijah had questions about foreign national? So hopefully we'll answer some of his questions right here. So
Yeah.
Our foreign national program it's just that. It's for foreign borrowers. So it's non-US citizens that derive their income from non-US sources. So they're paid in a foreign currency. You can do those, we can document the income several different ways, whether the borrower is a self-employed person or a wage earner. I mean, if you look here, we kind of made it kind of simple for you. If it's a wage earner that they work for the government of a foreign country, or they work for a company where they're paid equivalent to a US wage earner, we just want to get a pay stub or a pay ledger, and then a letter from that institute that they're working for defining what their income parameters are, much like a written VOE, if you will, but more in letter form on a letterhead. And if you're a self-employed borrower, we're just going to get a letter from their CPA, and their CPA is going to tell us what their earnings are, and that's what we're going to use to qualify the loan. In both of these cases, we're going to need to make sure that those are converted into US dollars. So if the letter provided or the pay ledger that's provided doesn't convert the income into US dollars, we'll have to make sure that it's translated into US dollars and that the letters are translated. How easy it is. We just need the letter, and then we just need to be able to validate it. How would we validate it? We might be using Google to validate the foreign company. If they're a wage earner, and if it's a CPA, we're going to be looking for some form of validation. They don't call them CPAs like they do in the US. They might be called an accountant or some other additive. Sometimes it's a lawyer that they work with that prepares their taxes in their country. So we're just going to need to be able to validate that. which is, we do it a number of different ways. I always try to get an email and try to send an email to get them to validate it that way once I've looked up the company and verified that they exist. Super easy. Probably one of my favorite features about the foreign national is it gives a lot of flexibility and a lot of buying power to the customer. Rose, was there any other questions specific to that?
Yeah, I think he wants for foreign nationals. I'm aware Venezuela as well as other countries don't qualify, but what if the borrower holds a European passport? However, let's see, holds a however, all the docs are provided from businesses, properties, and businesses in Venezuela.
So Venezuelan income is, unfortunately, we cannot accept it at this time. I don't know that when the rule of thumb is the sanctioned list. If they're on the sanctioned list, then that's not going to be if the country is on the sanctioned list, unfortunately, we wouldn't be able to do the foreign national. Regardless of the reason the country is on the sanctioned list. If they're on the sanctioned list, we wouldn't be able to do it.
Okay. Can DSCRs, can foreign nationals do DSCRs?
Yes, they can.
Yes.
Okay.
And it's basically the same qualifying criteria as it would be on the DSCR. There's some adages you might have to have additional reserves. If it's no visa, it might be a little bit lower on the LTV. So there are some caveat differences. Your AE can help you with that.
Yeah, I think the maximum LTV is 70 versus 75 on the investor cash flow.
Okay.
Great. So I think we're going to move on to the next, which is what I like to call the trust fund baby loan. It's the asset depletion and the asset qualifier products. These are for those borrowers that may have significant assets, but they're not working. They're certainly credit worthy. They've got the down payment, they've got the reserves, but they just don't have an income stream that we can use to qualify them for. So on my asset depletion program, well, very, very sensitive today, Rose. So on my asset depletion program, basically it works like this. We're going to take the borrower's cash assets, and I'm going to use 100% of that. I'm going to add 80% of their stocks and bonds, and then I'm going to add 70% of their retirement assets. When I total that number, I'm going to divide that number by 120, and that's going to be the number that I'm going to be able to use for their ability to repay. When I'm looking at a Fannie Mae product, a Fannie Mae asset depletion product, they divide that number by 360. So I'm basically tripling the Fannie Mae number. And Freddie Mac has a number that they're dividing by 240. So I'm doubling the number for Freddie Mac. So we can go up to 85 LTV on a purchase for these. I'm going to tell you, you would be amazed if you're going after the right customer, if you're spreading the word with financial planners and with wealth advisors that you have these products available. These people would look for these loans. They want these loans. So it's about you spreading the word, educating yourself, and then educating the people that can refer this business to you. And I promise you, you will get some of these deals.
John, Fannie also wants you to be retirement age.
Great point, Tim. What do we have to be? How old do they have to be with us?
Over 21.
There you go. So if you've got that trust fund baby that's got $10 million in the bank and he or she wants to buy that $2 million property at 85 LTV, and they've got all the, they've got the credit, they've got the credit depth, they've got everything we're looking for. You know what? We're going to find a way to get that loan to the closing table. Now, so in addition to the asset depletion program, which is where I'm going to divide that number by 120, we also have a product that we call the asset qualifier product. The asset qualifier product, I'm basically taking the same qualifying assets, the difference being I'm going to divide that number by 60. So I'm actually doubling the income figure that I'm willing to use on my asset depletion program on my asset qualifier program. But here's the difference. On my asset qualifier program, because I'm dividing that by 60 and being very, very aggressive on my income, I'm going to be looking for my borrower's post-close assets to be my loan amount plus 60 months of debt service. So it's pretty restrictive. However, I will tell you, I am amazed at how many borrowers actually have significant enough assets that they qualify for this loan all day long, every day. Tim, how many of these do we do a month? I mean, it's pretty.
Yeah, it's significant. I wouldn't be able to put a number on it, but I would say the DTIs go as high as 50 on both these programs, but we also allow stacking with all of our income types, like Loretta mentioned earlier. So that also helps in some ways from a debt ratio standpoint. because in that same example, you saw the payment was lower. So
Right.
you help your borrower qualify there using that with any of these income types, not just the DSCR.
You know, one of the great things about all of our programs, and it's not just with asset depletion and asset qualifier, we actually, and I love it, Loretta. I think you're the one that uses it. You called it hybrid income, and I think it's right, and it's where, yeah, and it's where we have the ability to take different income types and meld them and find a way to get your loan to the closing table. You know, let's say that you've got a borrower that's a bank statement loan and the spouse has W-2 income. Well, you can go ahead and take the bank statement loan, take that income, and then add that to the W-2 income. You might have something that, and here's a perfect example, and actually here's one that we actually closed not too long ago. We had a loan where the borrower was recently retired. Hold on, come back to me. Recently retired, had Social Security income and a small pension, wanted to purchase a second home in Florida. They'd gone everywhere for this loan. Fannie, Freddie, they went to a couple of different brokers actually, and one of the brokers actually finally reached out to me, said, I got a problem. I've got a DTI problem. There's just no way I can get this borrower to qualify. What can I do? Well, we took a look at it. What we did is we grossed up the Social Security. We added the pension income to that. And then we took their assets and we added asset depletion income on top of that. And that's basically what took them over the top and allowed us to be able to close this loan. Now, the borrower could have paid cash. They could have taken all the money out of the retirement account and paid cash for this property, but they did not want to do that. So, you know, doing something like this, to your point, Loretta, the hybrid income, you know, always take a look at a transaction and say, I've got this guy who's 25 years on the job. He works in the factory. He's got decent income, but I'm having a DTI problem. I just can't seem to get the thing to work. He's got that's a W-2 income, but he's got $450,000 in his 401k. You know, that might be the difference between you being able to get to the closing table and not. And I know, Loretta, you've had a number of these, haven't you?
Every other day.
I want to share with the audience too, is one thing to keep in mind. We rescue loans all the time. Tim, correct me if I'm wrong, that it'll come to us because the debt ratio will not work somewhere else. And they're a 50, 60% LTV. We will go in and say, listen, I don't want you to put as much money down. How about I give you a 70 or 75% LTV loan, leave some of your assets over here with your other assets so that you meet the minimum qualifiers to get into asset depletion or asset qualifier. And the loan ratios by using that additional income. And guess what? As a broker, you get a higher loan amount, which is what you're compensated on. So it's not just about, it's also about keeping more money in your borrower's pocket.
Yeah, and John, just for the record,
At a higher loan.
I was just going to say, just for the record, Loretta is the queen of hybrid income. I see about one a week from her. Matter of fact,
He just approved another one for me last night. So thank you, Tim.
Loretta's very good at what Loretta does. No question about that.
She definitely works hard to figure out a way to make some of these things work.
Listen, it's all about trying to squeeze the dollars.
That's right. That's right.
You know, you brought that up, Tim, and there's no question about it. I mean, you talk about Loretta works hard to get everything done. I can say that that's the culture at LendSure. I think the culture, and it's right from the top, and it goes right down to every level within this company. Is we are really truly looking for a way to get your loan to the closing table, and we're going to work hard to make that happen. We can't make them all happen. We wish we could, but we can't. But I'm going to tell you what: if there's a way to get the loan done, we're going to find a way to do it.
Well, that's what we're here for, to close loans. We don't close loans, we don't have jobs. So we got to figure out how to close loans.
Point. Buzzkill, but a good point, Tim.
Yeah.
So Loretta, you want to do a brief overview of this?
I'll grab this one and take her home. So just to touch a little bit on the LendSure opportunities, I'm not going to touch on all of these because you can see some of these products we touched on a little bit more in depth. But just keep in mind there's some advantages here. Like I think the bridge loan is a good opportunity, mentioning the fact that we do 1031 exchanges. You know, don't forget that our second home product, we beat everybody out there. Like conforming, Fannie, Freddie, they don't love second homes, and LendSure loves them. So our pricing is extremely competitive. So keep an eye on that. I personally think that we should be your first stop, not your last stop. I don't think you should wait for it to fall out. Just bring it to us from the get-go. So the second homes, the condo tells, I know we talked about it just a smidge earlier. So as you can see here, there's a whole list of products and menus, takeout loans, et cetera, et cetera. So if you need any information about any of these products, please reach out to your account executive or one of the managers. And then also be on the lookout for some future webinars, because we dive into some of these products when we do our webinars one-on-one with our broker partners.
If you don't know who your account executive is, or if you're new to LendSure, go ahead and reply to me, to the email that you're going to get in about an hour with the webinar recording, and I will happily connect you with a LendSure account executive to help you with scenarios and answer all your questions.
Awesome. Thank you, Rose. So I'd like to share with you guys something that's relatively new at LendSure, and we call it Spark. And Spark is it's an online pricing engine that's been available probably for about 30 days or now. It gives you the idea, basically you enter in 12, 15 pieces of information into Spark, and it's going to spit out what are the products that are available based on that scenario, and then it's going to give you all the pricing options that are available. Unlike me, unlike Loretta and our account executives, this is available 24/7, 365, and it's on our website, and it's really easy to get to. Minimal information in order to get, again, what programs does it qualify and get the pricing options. Understand this, and we talked about it earlier, we make exceptions. So if your scenario does not qualify under Spark, it'll tell you why it doesn't qualify under Spark. Even then, if it doesn't qualify under Spark, give your account executive a call and let us know what are the compensating factors on that transaction. We'll try to find a way to get that onto the closing table, because again, we do make a lot of exceptions, and we'll continue to do that again for those transactions that have the right compensating factors. So contact your account executive today to get a demonstration of Spark, and they'll be more than happy to do that. Just for your information, here's a screenshot of our homepage, and you can see there's a lot of resources available on our website, our specialty loan programs, our loan programs, brokered resources, contact information. It tells you a little bit more about us. And then again, right there, you can see Spark pricing engine on that green arrow. So again, Spark, great product. If you don't know how to use it, log into LendSure.com, go to the Spark pricing engine, contact your account executive. They'd be more than happy to spend a little time doing a demonstration of Spark for you. Rose, tell us about
the private
marketing
label
materials.
resources. So it could be overwhelming with all of the new programs that we threw at you today, but I put together a private label resource kit for you. You can go in here and download these banners and flyers and such. You can download them. You can customize it, add your logo, add your contact info, add your disclaimer info, so that you can start reaching out to realtors and to borrowers right away and start generating business right away. So you look for the link within the email that you're going to get about an hour after the webinar ends to access the private label resources.
Thank you, Rose.
So we have lots and lots and lots of questions. I've got a couple of different questions on the LLC about how long does it have to be opened? Can it be a new LLC?
Yeah,
It can be a new LLC. It's just got to be in good standing. So it's got to be you got to be able to look it up and validate it if it's in good standing.
and on a DSCR, I mean, we allow them to go open the LLC to purchase the property. I mean, it'd be brand new. So
yeah. And Gary, you don't need to log into the to LendSure.com to access the webinars, the broker resources, and the Spark engine. But if you want to, but there are instructions in there. If you want to submit a loan, you don't have to be even access to the TPO. I can get that started for you. Just reply to me, and then I will connect you with a LendSure account executive to help you with your scenario. You don't have to be an approved broker to start a conversation with us. The Spark Mike, the Spark engine is available now. You can go to LendSure.com right now, click on Spark, and be able to price out your loan scenarios. Prepayment penalty.
If I could, Rose, on Spark, I would strongly suggest that after you go in there and play with it a little bit, get with your account executive, because there's some great tricks, and if you know what the tricks are, you can really take advantage of that engine. Would you agree with that, Loretta?
I would definitely agree with that.
Okay. What if some properties are not in the borrower's name but in a corporation?
As long as they're the owner of that corporation and we can trail that to them, we can close in an LLC or an S corp. It doesn't matter.
Okay.
So they just have to be the owner.
Rose, yes, you are going to be getting a copy of the slides. A link to them is going to be in the email that you're going to be getting within the hour. So Joan wants to know, are you using the gross prospective rents or 75% of market rent?
On a,
So
On a DSCR, we're using the gross rents. On the full doc, we're using 75.
Okay,
well,
and then
purchase on a full doc, we'll use the 1007. I mean, prospective rents based on their appraisal.
okay, and then I had a question. I saw it in here. Now I can't find it. So you've got a house, an investment property, and it is a short-term rental. So you calculate the market rents on that, or what the actual short-term rental income is going to be, because presumably the short-term rental income will be much higher.
So I guess this is going to be me.
That is going to be you there. You noticed John and I were like,
Yeah. So if it's in a short-term rental market and we can get the appraiser to provide us commentary on the short-term rental and the amounts, then yes, we will consider short-term rental for our DSCR calculations.
Okay. Marco wants to know, how many months of investment and bank statements do you need for the asset depletion and qualifier programs?
so their most recent 60 days worth of asset statements, if I heard that question correctly.
Yes, yes, you do.
So you need the two most recent or a quarterly statement if it's a quarterly statement, the most recent quarterly statement.
Let's see. Linda says, I don't understand the difference between the two asset qualifier programs. One is divided by 120 and the other divided by 60. But what was the situation difference?
So on the asset depletion, we're dividing by 120. So our income is going to be less than would be on the asset qualifier. On the asset qualifier, we're dividing by 60. So we're basically doubling that income number. The big difference is the post-close assets. The post-close assets for the more aggressive asset qualifier have to be my loan amount plus 60 months of debt service. So let's say my loan amount is $1 million. And let's say that their 60 months of debt service is $100,000, then their post-close assets have to be $1.1 million.
And the minimum post-close assets is 500,000,
Correct.
regardless of those other two calculations.
Got it. Sorry if I missed it, but if using assets to qualify, what's the maximum LTV?
85.
To say, because we have the full product, yeah.
Okay, do you do properties over 5 acres? It says a luxury home on 5 acres.
We
Absolutely.
do.
Oh, great.
I did one last week on 35 acres.
That was for me.
I know.
Are manufactured homes allowed in any of our programs? Tyler
No.
wants to know.
Cannot do them currently.
Okay. What are the recent changes on DSCR for short-term rental properties?
Recent changes.
I'm not sure what she's referring to. Kelly, if you can clarify on that, I would really appreciate it.
Well,
And
we
then,
started allowing, short-term rental rates to be used, but we have to have it strongly verified. Now, if it's a refinance versus a purchase, it's a little bit easier if they're already using it as short-term rental because we can obtain the statements and use those. I didn't mention that earlier, but that's.
I think the only recent change is that we didn't previously allow it and that we do allow it now in the most recent 90 days, would you say, Tim, maybe a little longer?
Yeah, I mean, it's just become so prevalent. One of the things that recently came up, though, is we also are looking at to make sure it's legal and conforming to have a short-term rental. It's something that's started to come up. We recently had one with, they were wanting to use short-term rental income. We're using it as a short-term rental, but the city that the property was located in didn't allow it. And that created some issues. But in this case, we were actually able to close the loan because they had a permit. The city had to provide you a permit.
In that vein, Tim, on condo tells, they could just, like, if it's a condo tell or something like that, they can just provide the CC&R so that we can back up if it's a permissible use of the property, right?
Exactly. exactly. And it's, you know, each deal's kind of stands on its own. But I would say that's true of a lot of our loans. We don't, as we've been saying all along, I think the thing that differentiates us from so many other people is we do make exceptions. We look for loans that make sense and are going to pay us back. I mean, that's kind of our biggest niche, if there is one, is that if the loan makes sense, just because it doesn't fit in the box doesn't mean that borrower doesn't deserve a loan.
Okay. On the 40-year IO, do you qualify on the interest only payment?
On an investment property, we will qualify on the interest only payment. On a owner occupied property, we will qualify the borrower based on the fully amortized payment.
Awesome. For Vincent wants to know, I'm licensed in California. If I have a borrower that wants to purchase a rental property in Nevada, do I need to be licensed in Nevada to help this buyer?
Yeah, the license is where the borrower or where the property is.
Okay, got it.
Well, but if in some investment properties in certain geographies, they don't have to have a
Like,
license if it's
for instance,
business
you don't
purpose
have
only.
license there. You're right. If it's an investment property.
Correct.
And it's business purpose. I mean, if it's
Correct.
purchased,
Right.
it would obviously be business purpose.
Amy wants to know, can we make 3 points on our loans that we submit to you guys?
Yes, you can make up as much as 3%. Maximum LPC is 2%.
Okay. Can a borrower pay the lender compensation instead of having it financed into the loan amount?
Yes.
Absolutely.
Yeah.
On the 1099 program, how many years of 1099s do you require, and what is the max LTV for a purchase and for cash out refi?
We can actually go as low as one. What's the LTV on that? Do you guys have that in front of you?
The
I
one,
didn't quite hear the question.
The 1 year
On-
1099 program?
Yeah.
So
On the
you-
1099 program, how many years of 1099s do you require, and what is the max LTV for purchase and for cash out refi? Mark
So the
wants to know.
term of the employment is still the same. It's 2 years from a if you've changed, it's same line of work, and then we'll look at those on a case by case basis. But if it's a one, so I think correct me if I'm wrong, but the question you're trying to ask is if you have somebody that's 1099 and they've been on their job less than 2 years, is that kind of what you're?
Yeah, I think 2 years is the answer that
Yeah,
Mark
so
is
2
looking
years
for.
is, but we will qualify off the most, will only require 1 year, but the source of the income is 2 years, just like a
Correct.
self.
right. But
Okay.
I had one last week. I mean, the guy had multiple 1099 jobs. You know, that he was a contractor that did the same type of work for several different companies. And so he may not be working consistently for the same company for 2 years, but he's been doing the same type of work for 2 years. And we average that income. On the 1 year program, if you go 1 year, you're capped at 80 LTV, though. They did ask about the LTV. So.
And
Okay.
just so you know, Sam, you just approved one for me where the borrower went from being W-2'd to being 1099. It was with the same employer, but they'd only been 1099 for the last 2 months.
I
And you could
approved that.
sit there.
No, but it makes sense. Again, that loan made perfect sense. The guy's
Yeah,
income, you know.
employer, that role switched by the employer. And so you said, yeah, that makes absolute sense to me. We're going to do that.
Okay.
So it's all, again, to the exceptions, common sense, like we got to just tell the story.
Yep. And the more information you give us, the easier it is for us to do that. We tell people all the time, don't be afraid to tell us what's really going on, because we're gonna talk to you about it and help you try to figure out what's the best way to structure it. You know, so many times people don't want to give us the information. Like Loretta said, oh, by the way, they got $500,000 in assets. Well, that might put us over the hump of what we're hung up on up until that point. So I think
you bring up a really good point there, Tim, because a lot of times people will try to do something through LP or DU, and they'll put less information on the URLA than they would. And more times than not, we're missing some information that we might need. So again, get as much information as you possibly can and populate it on the URLA, and it's going to make it easier for us to find a way to get your loan to the closing table.
I mean, we have so many loans that once we talk to the borrower and say, just tell me what's really going on here, because what you're giving me doesn't make sense. You know, you got somebody that's got thousands of dollars going through there. I had one the other day. Guy, average residual income, or his residual income per month was $10,000. But the asset statement that they gave us, he had virtually no money. That made no sense. But I was like, but the guy's paid his bills perfectly. So tell me what's going on. Oh, well, he has this other account over here that we didn't tell you about. You know, and I was like, that made me feel, all right, then this makes perfect sense. Move on down the road. So don't be afraid to tell us the whole story, and let us help you walk through what we can and can't do.
Okay. And I've got a lot of questions with very specific scenarios. This credit score, this LTV, will you do this? I want you guys to get as complete and accurate information as possible. So I'm going to ask you to reach out to me after the webinar with those, and I can have a um, account executive chat with you, review the scenario, and give you a solid answer on those specific loan scenarios. Now, Kelly has left, but she said, just chatted with my AE and she's going to send the scenario to Tim about this specific loan, exclamation point. So Tim, expect to hear from Kelly.
I'll look for it. Send it on. That's what we want.
It's the
right.
best one I've ever seen
Check my email. Not
on
in
one
there.
of the webinars.
So as soon as I get it, I'll jump on it, but it's not there
Okay,
yet.
and Joan asked the question about short-term rental and how we determine the income, but I think we already answered that one. And will you be sending the PowerPoint? Yes, I will. Can you finance tiny homes?
No.
Yeah.
We can go down to a very small condo.
Trying.
I mean, our minimum square footage is 500, but we don't necessarily do tiny homes, but we will do condos and condo hotels that are small.
And I've got several questions about prepayment penalties for DSCR.
So all of our investment property loans, if it's allowable by law in the geography, come with a standard 3-year prepayment penalty. It can be bought down to 1 year and actually can be bought up to 4 years.
Okay. And Melinda, no, we do not do VA loans. And then, and I think that is it for the questions. What are the LTVs and property types and occupancies allowed? Also, you know what I'm going to do? I'm going to include the program matrix along with the other items that I'm going to include with you. That's going to give you an overview of different LTVs and loan amounts and all that stuff. So you'll have all of those things. You guys have been great. Thank you, Mark. That was very kind of you. You're very welcome, Melinda. And Gary says, "Go dogs."
Probably looking at the sign behind me that
Yes, that's what he's.
I just say roll tide. That's all.
Yeah, well,
All
we like the Nittany Lions up here.
Oh.
All right, last question.
I don't even know
All
what
right,
that is.
Final question. I've got a bunch of people asking about it. ITINs. Let's talk ITINs.
It's very specific criteria, but yes, we do I-10 borrowers. You have to be super careful about the income. I would recommend that everyone reach out to, if you have specific regards to an I-10, definitely reach out to your account executives because there's some nuances to it.
Yeah, and that's the one program, and I'm just going to go ahead and say it, that we don't get outside the box on. It is probably the only program we have where I just, you know, we have a lot of people don't like those loans. We're still doing them, but they need to fit the box. So.
Yeah, and it has some very specific circumstances around the income. It has to be 2 years worth of income period. There's no deviation from that. So there's some, it's probably a no flexibility product. Like it fits or it doesn't. And if it doesn't, unfortunately, we won't move forward. It's being an exception-based lender, why we don't bring them up on the webinar.
Yep.
And Fernando, for where do you submit your bank statements for review? If you to your LendSure account executive, you can get those to them securely. Is that correct, Loretta?
That is correct. They will send you a link where you can send them in secure.
And Fernando, if you don't know who your LendSure account executive is, just respond to my email in about an hour and I will connect you with him or her.
And we're turning those, like if somebody wants us to calculate the income up front, we're turning those in what, 24 hours or less right now, right?
As a rule of thumb, yes.
So
All right.
it's not like you got to wait 3 months to figure out what your income is.
With that, I would like to
89
thank
days, Tim, 89 days, not 3 months.
All right. With that, I would like to thank everybody for joining us for today's webinar. I'd like to thank our speakers for joining our webinar today. And again, if you have any questions, go ahead and respond to the email from me, Rose Waldy, that you'll be getting in about an hour. Loretta, any parting words?
Yeah, just looking forward to hearing from you guys. There's a lot of great questions, very engaging. So we're really glad that you guys participated, and we're hoping to see some emails and some connecting you with some AEs.
Awesome. Tim, any final words?
I would just say thanks. Look forward to doing business, and anything I can do to help anyone, please reach out.
Awesome. John?
I guess the only thing that I would add to everything we've said is to educate yourself onto the non-QM products that are available through LendSure, and then educate your customers, your realtors, your financial planners of the products that you have that can differentiate you with your competition. These are the things that, especially in the current market conditions, that will enable you to do more business, to close more loans, not only for yourself and for your company, but also to close more loans for your referral sources. So again, become educated, educate your consumers, and if you need help, get a hold of your account executive, get a hold of your regional manager, and we'll be happy to help you.
They do that all the time. Go on realtor presentations with the loan officers to present them with all the different options, and they're very grateful for that opportunity. The realtors just love that information.
And Rose, your non-branded materials that you've created that the brokers can use that does not have the LendSure branding, that they can use those flyers, those banners, etc., and they can use them for their marketing purposes.
I even have videos on there, and if you need a slide deck, let me know. I can help. Me and your account executive can help you do that.
Yep.
All right. Well, everybody, thank you so much for joining us, and have a great day.
Thanks, guys.
Roll Tide one more time.